All right. Well, welcome everybody to the THG Retirement Solutions quarterly market review in our new format, first time here on YouTube. So we've got a new platform, a new format for you, and all of our future episodes will live here for our investment strategy quarterly, plus many other resources that we'll have for you. So I'm Ryan. I'm happy to be joined by Stephen, and we want to welcome all of you here on behalf of our whole team. Where we're going to talk about the investment strategy quarterly document. It's a document that's put together by the Raymond James Investment Strategy Committee, which is led by Larry Adam and consists of multiple CFAs, CMAs, CFPs, PhDs, a lot of very, very smart people on that team who run that committee. And they've put this together each quarter. So as a supplement to our quarterly market review and your investment review or your quarterly touch base on your account, we just like to provide this some commentary around the themes and the topics that are being discussed this quarter. And so with that, welcome, Stephen, and glad to be with you here on YouTube.
Thank you. This should be fun.
Our new home.
Yeah. I look forward to it.
Yeah, me too. So this quarter, the ISQ is laid out and billed as sort of the Great American Road Trips. So sort of the theme of the investment strategy quarterly is sort of road tripping around the country and discussing the hot button issues that are affecting markets and the economy, and of course the upcoming election. And this full document is available for you on our website, thgrs.com, under the resources tab. So if you want to read along or if you want to read a little further on any of these topics, we would certainly encourage you to do that. But the three main areas for discussion today are going to be trades and tariffs, the upcoming election, as I mentioned, and then the inverted yield curve. So before we dive into kind of those three areas that they talked about, I think, Stephen, what would be helpful is just to kind of start with a backdrop or sort of an overview of the current landscape, where we're at now, where we are sitting here this quarter. I know last time we were sort of talking to clients wondering, is the Fed really going to stick this soft landing? By the end of 2024, are we going to be in a recession? Is that going to be the October surprise, right before the election? So kind of give everyone a quick overview of where are we at now and kind of going into the end of the year, how do things sit?
Yeah, thanks, Ryan. Yeah, I agree with, kind of looking back at last quarter and several quarters prior. We've been anticipating for a while now that there's going to be a slowdown, and really that question is a recession coming? When is it coming? So really at each point where we've been looking, and we've looked at the consumer, business, the government spending, it's all proven super resilient. Things have been very strong, and I think going forward, we really can look at a lot of the same. GDP has been great. We're at looking like an expected 2.6% this year, a little less next year at 2% for 2025. The economy definitely is slowing down a bit, but we feel like there is definitely room for a soft landing if and when the recession does come. So we are not expecting a crash or anything major at this point, but we really think things will kind of be going along as they are.
Yeah, so it almost seems like we've kind of almost pulled it off, right? We've been talking about this soft landing for a while. It seems like things might just ever so slightly be lining up to actually see it kind of happen. So what are some of the things that you think are helping us maybe to avoid or to avert that recession, like you said, not crashing into it head on?
Yeah. Oh, one of the big things that, when you talk about recession is the job growth, and it's definitely slowing, which is a concern. And there was a little concern about a month ago on that. But when you look at historical standards, things look good. They're stable. So we've got the job growth at least kind of hanging in there. Businesses are spending. Businesses are doing well. They're still profitable, so that's a great sign. A big thing that I don't think is talked about a lot is that the government spending. 80% of the Inflation Reduction Act still hasn't been spent. So there's going to be a lot of focus on spending in the U.S. on reindustrialization. So I think that's an important thing to think about from a growth perspective. And then we obviously have interest rates, which is maybe the most popular topic for the last year is what's going to happen and so forth. And we finally got that cut in September of 50 basis points, which was kind of that 50-50 for a while. Is it going to be 25? Is it going to be 50? They went with 50, and you saw some volatility right following that. We think there'll still be another 50 throughout the end through the end of 24. So we think we'll have 100 basis points this year, and we think next year will be the same. So another 100 basis points are on the table for 2025. So I think if we keep getting the rate cuts, that should mean that things are going along as expected, because inflation is going to be the big driver in all of this. So, we expect the reacceleration of the economy with lower rates, things will look really good next year, and that should be great for the stock market. Rate cuts, obviously, lending rates for businesses, lower rates is always a positive. Earnings growth looks good. Earnings are still growing, maybe not as fast as they were before, but they're still growing. And then there's the record level of cash on the sidelines. There's actually almost double the amount of cash in money markets today than there was pre-pandemic. So what that really means is there is some dry powder money that can get back into the market that's kind of sitting on the sidelines. So and I mentioned inflation, and I feel like I go back to that a lot. But the Fed concentrating on maintaining the inflation numbers with the economic and employment numbers looking good to keep the inflation hopefully lower, at or lower where it's at right now. Again, there's a lot of things that are fighting against that. So I think the Fed still has a task ahead, and hopefully they don't lower rates too quickly, and that interest rates that inflation doesn't get out of hand. But I think that the big concern really would just be consumer spending. So if we keep high rates, and you've got mortgages are high, you've got lending on credit cards and auto loans and everything else. If all of that is high and we do get a shift in the consumer, that's going to be kind of that next step towards recession. So that's what we're really looking out for. So really, at this moment, we think things look better than we anticipated a year ago, a few quarters ago even, and that the year should finish strong. So we have a volatile year, as we'll talk about, but I think things are going well.
Yeah, things seem to be going well, and things, every look around every corner seems to be things are sort of a little better than we had all anticipated they would be at this point. And, we're on the verge of a presidential election. So we know things can, short term still get a little shaky. There might still be a little uncertainty, but, feeling pretty good today. And you mentioned the markets. You said the markets seem to be pretty happy. And if you look here at the capital market snapshot, it seems to be that as of at least the end of the quarter, if you look through 9:30 on this slide, but certainly if you look today, the Dow, the S&P, the NASDAQ, International, everyone seems to be pretty happy. Everyone seems to be digesting the news pretty well, and returns over the quarter and over the last 12 months are looking pretty healthy.
Yeah.
So with that, let's jump into the first kind of main topic that they tackled was trade and tariffs, and what the impact is to the consumer when it comes to trade and to tariffs. So we all know tariff, is a tax on imports, historically designed to, give domestic producers an edge. We know though that it could, definitely have the potential to raise all prices. It could raise costs that eventually get passed on to the consumer. So with all the talk about tariffs and different policy, and I know we'll talk a little bit more about this with the election topic, but with all the things that have been said about tariffs, particularly on the campaign trail, what does that mean for consumers? And depending on how these tariffs, may or may not be imposed, what should people be looking out for? What should people, and particularly investors, be thinking about when it comes to tariff and trade?
Yeah. Really looking at tariffs, China's been probably the most affected and been the most publicized for the tariffs in China. And they were all imposed by former President Trump. And obviously, I don't know if a lot of people know this, but they've kept all of those tariffs basically intact. So we've we've consumed them. We've gotten through them. Inflation hasn't been a problem with those tariffs. Obviously, additional tariffs are always a concern, and especially a shock when the economy is a little maybe more fragile. So, we need to definitely keep an eye on that. But in addition to tariffs, really the balance of trade. If you consider that the U.S. manufacturing sector has transformed over the last several decades, really things have gotten cheaper from an import perspective and put a lot of pressure on the sector's competitiveness. So although employment in manufacturing has declined, so we've had in the U.S. Since the 1990s, as you'll see on this chart, you also the manufacturing productivity has doubled. So really, you've got less people doing more through automation and so forth. And I don't think anyone thinks we're going to have less of that coming forward. So hopefully we can keep productivity or increase productivity and maybe reduce those costs of our labor force in manufacturing to be more competitive. For example, in 2022, the U.S. had an average salary for a manufacturing worker, including their benefits, to be $98,846. In comparison, in China, it was $13,638, and in Mexico, $15,804. So substantially higher costs to run manufacturing in the U.S. So it's really difficult to know, going back to your, the overall inflation questions and concerns, because that's going to be, like I've said, I think I've been saying this all year. Even though inflation's coming down, it's still my biggest concern. It's difficult to know what's the impact. But as we get tariffs and everything else to push that inflation potentially higher, it's going to put the Fed into a interesting situation. What are they going to do? Are they going to be able to, are they going to increase rates? Are they going to be able to keep rates where they're at for longer? Maybe we won't have that decrease. So, our view is that tariffs really should be looked at on a case-by-case basis, not as a blanket tariff policy, but it is really relates to that inflation number. So that's, I think, our biggest concern.
Yeah, definitely something to keep an eye on. Okay, so let's move on. The next topic is, I think, probably the big one, right? It's probably the one that's grabbed most people's attention, and here we are a few weeks out. Probably by the time anyone's watching this, we're going to be, right on the doorstep of the election. But it's a tight race, sort of uncertain outcome at this point. There's a lot of polls. Everything seems to be, pretty tight between the vice president and the former president. It seems like most polls are pretty much within the margin of error. So there's probably not going to be a ton of surprises. If you look at, the presidential race, I think congressionally, there's maybe a few more indicators that it's likely to swing one way or the other. But, in relation to, the presidential race as well as the congressional races and who kind of controls government, we know there's a lot of kind of hot button key issues that people are tuned into, things that people are thinking about, like taxes, trade and tariffs, which we already mentioned, housing. And there's a lot of policy proposals that are out there that are being talked about that, are making people kind of, certainly pay attention, but start to think longer term about, what are the implications of those policies if one party or another kind of takes control of certain aspects of government. So for an investor, from an investor standpoint, what do you think are some of the important implications of those policies that are being discussed? And obviously we're all kind of concerned about how it will impact us and our investments and our investment portfolios. But also, what should our longer term perspective be as it relates to the election cycles, and what should we be thinking about in terms of that as we go, head out to the polls this November?
Yeah, well, I think the comment longer term is key. We're longer term investors, on our team, and when we look at things, we don't look at what's happening over the next month. But when you look at elections in general, and you go back historically, things that you can expect: increased volatility. Anytime it's an unknown of who's gonna win, what's gonna happen. Obviously, as Ryan mentioned, we're focusing a lot on the presidential election, but there's elections for Congress, elections for the Senate. all kinds of other things going on that also almost equally could affect the way things go. At the end of the day, if the president is a Democrat or Republican, when you look at statistics over time, it really doesn't make that much difference. Again, with the Senate and Congress all having a say in tax policies and everything else that's going on in the world, just having that one factor doesn't always mean anything specifically ups or downs or who's better or who's worse. But what almost always happens, and as you see in this chart, is following an election, you have that known. And the stock market loves knowns, even if it's not the best known. And what happens is the market goes up, usually when you have a known outcome. So you kind of think back to elections, and you can think after the elections were over, what happened. You had a ton of volatility before, maybe even right after, and then ongoing. We're kind of set in a new way. So it's kind of the American way that we're moving forward. So it's important to know that you want to stay diversified, because you don't know. One thing you definitely don't know is, is it going to be small cap? Is it going to be large cap, international, U.S., where with different sectors? But, as long as you're diversified and you're going into this election and coming out of it with a diversified portfolio, it's really the best that you can do. And like I said, there could be some volatility short term, but long term it will look good.
Yeah, I think that's something that we can all agree on. Once the election's over, it'll all be better. Things will get back to normal. And yeah,
It'll
it's
be
nice
nice
to
not to
see.
talk about it as much, right? It seems
Yeah,
like it's been a very popular topic that, just when you look historically, it actually doesn't make that much of a difference. Where the Fed lowering rate almost has or inflation and things like that actually have a much bigger impact on the markets.
right. Yeah, yeah, I agree. It's nice to see though this chart just kind of showing that once the election is over, from election day onward, things kind of get back to normal, which I think everyone can agree on. Everyone's ready for. All right, and then the last topic was the inverted yield curve. And is that still a reliable signal? So the issue here, the topic that they're kind of talking about, is that recently we saw an uninverting of the yield curve, which historically has been, a fairly reliable indicator of an impending recession. So, you kind of mentioned this at the top. We don't think we're heading that direction, at least not right at this moment. And so when we look and say, well, yeah, but historically, the uninverting of the yield curve has meant we're basically heading into a recession. There are some things this time that feel a little different, and there are many, I think, who seem to think that this time that may be a false signal.
They do, and for good reason. The uninverted yield curve, typically the reason it goes from inverted to uninverted is because we have to push rates down to stimulate the economy. So typically that's really the reason that happens, is that you're trying to stimulate the economy and to get the growth. We already have the growth, so we're kind of getting fuel on something that's already moving along well. So again, hopefully it's different this time. It's been quite a while as far as having the inverted yield curve. It was almost 2 years. So the 2-year Treasury fell below the 10-year Treasury for the first time since July of 2022. That's the longest inversion period in history. So again, hopefully it's different. But the things that we look at is not all of the yield curve has normalized. There's still, if you go out beyond or shorter than the 2-year, it's still high. If you look at what short-term rates are today, you're still getting more on a 1-month Treasury than a 10-year Treasury. So it's still inverted in that sense. So it hasn't completely normalized, but hopefully this time it's different. The economy has been resilient despite the Fed's aggressive actions. The labor market's still strong. It's definitely cooling, as we were talking about, but unemployment rates are low. Usually, that number is something that's very important to look at for a recession. The Fed has been successful so far at taming inflation, so they haven't over tightened, they haven't caused any problems. They've done actually a really good job, better than I could have imagined from to taming inflation. So we've had some growth scares along the way. Things have been reined in. Inflation looks good. Or sorry, Fed has slowed the economy and reined in inflation without plunging us into recession. So I think everything's been, like I said, the Fed's done a good job. The yield curve is not a big concern for us, but so I don't think there's any reason to worry.
Good. So we don't have to panic just yet, right?
Right.
So, but what does that mean? Because a lot of people are sitting in cash. You mentioned there's a lot of cash sitting on the sidelines, waiting to kind of be deployed. I think the number I saw was about $6 trillion sitting in money market accounts. So people are used to and very appreciative of these higher rates. They're getting a fairly high yield with no risk sitting in cash. But we know as rates change that can happen very quickly. So what does that mean for those more conservative investors or those fixed income investors with all that cash sitting on the sidelines who are earning a decent yield? What does this change mean for them?
Well, I think there's still an opportunity to extend some of that, some of your duration out in that area. So if you're sitting in cash and you've been earning 5 or 6%, how can you complain, right? It's great to get that type of return without any risk. The problem is that if the overnight rates, if the Fed pushes rates down and we get down to a 3% Fed funds rate, that means your money market's going down quite a bit. So you could be losing quite a bit of money on that short, the overnight rate, where there's still opportunity that if you have money that you don't need for 3, 4, 5 years, that you can kind of extend out into some safer investments, even investment grade corporate bonds, things like that. I think there's a lot of opportunity in that shorter end of the market, but not ultra short, where you don't have the risk of if rates go back up, and you also can lock in a pretty solid rate still. So I think that's important.
Yeah, and I think some big themes for us and our team is obviously diversification and moderation. So you might not want to just dump all of your cash right at once, but maybe kind of shift it over time, into some of those investment grade corporates and stuff that you talked about. You see the writing on the wall, you kind of see the signals. So maybe start to think about that, and certainly you can reach out and talk to us. But if you want to kind of make a slow slide or a slow shift, you can start thinking about those considerations and maybe heading that way going into the end of this year and maybe the beginning of 25.
Yeah, man, the 10-year Treasury is at over 4% right now, as we're recording this. And so obviously you get more money on a money market, but you could lock in some longer term rates, and even with those, like I was mentioning, those investment grade bonds and things like that, you're going to get even higher rates. So it's definitely a time to have that conversation.
Okay. Great. And then, so before we wrap up, I think we should talk about maybe some considerations around, tactical and sector considerations. I know we normally kind of talk about that during our quarterly market reviews. So maybe we can end with that and we'll talk about tactical and then sector before we wrap this up.
Yeah, I think I've mentioned it a few times: diversification, probably inflation, diversification rates. You've got, in our opinion, everything's pretty neutral. We're a little underweight on commodities, but from a large cap, small cap, we if rates are going down, that's probably a good thing for small caps. They've been lagging for quite a while, so we like small caps a little bit more than as an overweight. But as you can see here, nothing is too far out of whack. Definitely on the fixed income side, like that investment grade bonds, as opposed to the higher yield, the lower higher risk, I guess we'll call it, bonds as well. So, but everything's pretty neutral. And then from a sector standpoint, you can see what we're overweight and underweight from that perspective. We like technology, healthcare, industrials, and energy as overweight sectors. Technology, maybe not those top few names that have been riding the S&P 500 higher, but there's still a lot of names that have room to move. In industrials, we talked about the reindustrialization in the U.S. So I think there's a ton of momentum, and through this election, there's got a ton of money that's got to be spent in that area. So I think you really feel like it's a good area to be overweight. And then energy, it's a smaller weight in the S&P, but we definitely think that energy still has upside. Underweights, we've got real estate, utilities, consumer discretionary, and materials. Nothing there probably that's a, a big surprise. Utilities, maybe a little bit, but I think it's something to look at. Like I said, if you have any questions on this stuff, maybe a one-on-one conversation would make sense.
Awesome. All right. Well, I think that will do it for this episode. So thanks to everybody for joining us. I hope you enjoyed it. For anyone who's still listening or who made it through the whole video, extra brownie points and kudos to you. Be sure also to check out the full investment strategy quarterly if you're interested for more detailed insights. You can go to our website at thgrs.com and click on the resources tab at the top, and you can find a copy of the latest here. If you want to subscribe to the channel, you'll get notifications for future videos, but we're going to be posting these each quarter here on the ISQ for our quarterly market updates, as well as many, many other videos and many other resources for you and for your benefit. So be sure to check back soon and often. And thank you all very much for watching. Take care, everybody.
Yeah, thank you.